Welcome to the deep dive. So, you've given us this great stack of sources on what's happening in the global financial markets, and our job today is pretty clear. We're going to boil this all down. If you need to get up to speed fast on, what's really slowing down the market, what the core risks are, this is your shortcut.
Exactly. And what's really critical to grasp here is that the market's at a major inflection point. We're shifting away from that phase of just, aggressive, rapid growth, and we're moving into a time that's much slower, more selective. So we're going to focus on two things: central bank policy and inflation, and the big reality check hitting tech valuations.
That sets the stage perfectly. Okay, let's unpack this. And I think we have to start with the biggest thing weighing on the markets, which is that great tech valuation reckoning. Because when we look at the data, the broad global indices, like the MSCI's measures, we're not seeing a crash. Not at all. It's more like a significant stall.
Stalled is the right word. It's coupled with this slight downside pressure.
Yeah, it's like you're running out of gas while going uphill, not, slamming on the brakes.
And that feeling, that running out of gas feeling, it's rooted in those two dynamics we just mentioned. First, you have investors who are they're nervous about these valuations that look so stretched, especially in tech.
Right.
And then second, there's just this lack of clarity from the Federal Reserve about interest rates.
Yeah.
And those two worries have started to really feed on each other.
And this is where the real intellectual challenge is for investors right now. The anxiety isn't about AI itself, right? It's the accounting. People are finally asking out loud, okay, we're spending all this massive amount of money on AI infrastructure. Are we actually going to see the profits we were promised?
That shift in the question is everything. It moves the focus from, some far-off story to the actual cash flow today.
So what are we seeing in the market with the big tech names?
It's not panic selling. I want to be really clear about that. It's something much more deliberate. We used to see investors just buying en masse.
Yeah.
Right? That whole fear of missing out, FOMO,
Sure.
that's being replaced. Now, fund managers are holding on to their capital, and they're waiting. They're looking for what they see as a defensible price to get in.
They want to see the numbers.
They want to see the numbers. They want transparency on cash flows. They want a clear path to profitability that actually justifies these, frankly, sky-high multiples.
So the big takeaway here is that the era of, let's call it aggressive, rapid-fire growth, that's over. The market is basically doing an audit. It wants maturity, it wants governance, and it's being extremely selective.
And the demand for selectivity, it's being enforced by macro policy, which I think brings us to the next big driver, central bank policy.
The thing that sets the price for everything else.
Exactly. The message from the Fed, from other central banks, it's basically unified at this point. Any idea we had about a quick timeline for rate cuts? Well, that's just not certain anymore. Expectations have been seriously tempered.
And we don't have to just listen to them. We can see it in the bond market, right? The evidence is there. We've seen this really noticeable climb in U.S. Treasury yields.
Especially on the longer end, like the 10-year.
Right, the 10-year benchmark.
And that movement in treasuries, that's the market consensus forming in real time. It's confirming this idea that interest rates will be higher for at least a while. The whole higher for longer thing is really hitting home now.
Okay, so let's connect this directly back to the tech valuations. This is so important for anyone trying to analyze the market. Why does a little tick up in the 10-year yield cause so much anxiety for a software company?
Well, it's all about the math, but it's fundamentally important. When that risk-free rate, which is basically what the 10-year treasury is, when that rises, it raises the discount rate that everyone uses in their financial model.
In their DCF models,
In every single discounted cash flow model, and these high-growth tech stocks, almost all of their valuation comes from profits they're projecting way out in the future, 5, 7, 10 years from now.
So when you use a higher discount rate,
those distant future profits are worth a lot less today. Suddenly, those projections are much, much harder to justify at the current share price. And that's the structural link. That's why the bond market's anxiety is causing the stock market to stall.
This is where it gets really interesting, because if we understand the attention rates versus tech, we can start to make sense of some of these other smaller movements in peripheral markets.
Absolutely. If you look beyond the big indices, you see some interesting things happening in commodities. They're often a good barometer for global trade. For example, global rubber prices have had a measurable short-term pop.
Okay, rubber prices, why?
On the Tokyo Exchange, prices were up something like 4% compared to the week before.
And that's tied to currencies, I'm guessing?
You got it. It's tied to a modest recovery in the Japanese yen. When the yen gets a bit stronger, It changes the competitive landscape for Japanese exports, and that increases demand for raw materials like rubber.
Hmm. Meanwhile, the US dollar is staying strong.
Generally, yes. It's holding steady, which keeps the pressure on everything priced in dollars. It's this constant tug of war, but the Fed's policy is still the heaviest weight on the scale.
Speaking of weights on the scale,
Mhm.
let's talk about a risk alert that's coming out of the emerging market space. This is something that really needs to be on everyone's radar right now.
It does.
Managers are seeing that certain investment strategies, specifically these things called carry trades, are starting to get, well, dangerously crowded.
And this raises probably the most important systemic question right now. Why is a crowded carry trade so alarming?
So break it down for us. What is a carry trade?
It's basically arbitraging interest rates. You borrow money in a currency where interest rates are super low, like the yen,
Right.
and you invest that money in a currency where rates are really high, often in an emerging market.
Okay, so you're pocketing the difference.
You're pocketing the difference,
Yeah.
and it works beautifully
Yeah.
until it doesn't. When too many investors are all piled into the same trade using similar leverage, the hidden risk just explodes.
So if there's a surprise, like an unexpected policy shift.
Right. If the emerging market central bank disappoints, or if the U.S. dollar makes a sharp move, you get a mass exit, a stampede. And that rush for the door can cause a catastrophic reversal that freezes up the entire market segment.
That is a textbook definition of systemic risk hiding in plain sight. And if we connect this back to the bigger picture, it's a reminder that even though overall economic sentiment might be sort of okay, the engine is fighting some major headwinds.
Exactly. Geopolitical tensions, supply chain issues, policy volatility, all these things are still there.
Yeah.
The volatility we're seeing isn't happening in a vacuum. The market is just highly susceptible to shocks right now.
So for you, if you're putting together a report or talking to your team, we've got two really actionable takeaways from all this. First, your strategy just has to shift. It's all about risk-adjusted returns and resilience now, not just aggressive growth. You have to advise caution, especially with these crowded trades we're talking about. The potential for a sharp reversal is, well, it's mounting.
And second, in terms of your narrative, the themes you need to focus on are policy risk, that's the Fed's uncertainty, interest rate volatility, and this intense debate around the justification for tech and AI spending. These are the areas with more questions than answers right now.
That's the perfect way to frame it. So if you're setting an agenda for a meeting, a great theme would be, why is the global market stalling despite all this technological promise? And you can break it down with the angles we've discussed.
The challenge of justifying AI spending with rising costs and that stubborn higher-for-longer rate environment.
So what does this all mean? I guess it means the landscape has just fundamentally changed. It's gone from rewarding speed to punishing anything that doesn't have real quality and demonstrable cash flow.
And my final thought for you, building on that carry trade warning, is this. When a trade becomes so popular that it's the obvious thing to do, that is almost always the exact moment that the hidden risk is at its absolute peak. You have to be incredibly wary of market consensus. It often hides the biggest problems.
A perfect final insight. Use these points, use these narratives to inform your own work as you navigate what is a very, very demanding market. Thanks for sharing your sources with us for this deep dive.